Hello, I'm Brent Joyce, Chief Investment Strategist at BMO Private Investment Counsel. It's Friday, May 3rd. Welcome to our Global Markets Commentary. The theme for April was shake, rattle, and roll. April brought shaking to the equity markets and rattling to the bond market. However, we saw continued rolling recoveries in housing, manufacturing, and non-U.S. global economic growth, all of which support our positive outlook for capital markets. Since the beginning of 2024, we have been warning that equity markets were ripe for a consolidation of their recent gains. A smooth, uninterrupted 5-month advance for equity markets was certainly welcome, but a pause was in order, and a pause is welcome and healthy. Investors need reminding that risky assets deliver premium returns because they are risky. Remove the uncertainty, i.e. that markets only go up, and complacency will drive the premium opportunity away. Capital markets had plenty to digest in April: warm U.S. inflation, cool U.S. GDP numbers, and unfortunately, geopolitical flare-ups that escalated the ongoing misery in a number of global hotspots. In our view, April's equity market slides of between 3 and 5%, they're run-of-the-mill volatility. We are encouraged that markets held up in the face of pretty gloomy headlines. However, much of April's real story was not so plainly visible. When we look deeper, some of the data reveals silver linings. Among the adverse developments that shook markets, the worst was a familiar culprit: U.S. inflation. After upside surprises in January and February, March's hot reading was too much to ignore. While the decline for U.S. inflation has stalled, inflation remains well below the peak. But it's also not close enough to the Fed's inflation target to bring as many interest rate cuts as investors previously expected. Adding to the bad vibes from the U.S. data was a seemingly weak Q1 U.S. GDP number, as U.S. economic growth for the first quarter slowed more than expected. This combination of warmer inflation and cooler growth, it brought the naysayers out, calling it stagflation. Let me be very clear. The data does not support this moniker. 1.6% real GDP growth is far from recession. But more importantly, inside the GDP report were several silver linings. The negativity stemmed from less government spending and more imports than exports. The true heart of the U.S. economy, consumers and businesses, that remains strong. If this is a lousy GDP report, give me more. Given profligate government spending and ballooning deficits, lower spending by Uncle Sam, that's more than just a silver lining, that's very good news. And when the US dollar is strong, like it has been, you expect more imports and fewer exports. This too is a silver lining. Cheaper imports bring lower inflation, and they transfer demand, i.e. economic growth, to the US's trading partners. We want U.S. growth to slow somewhat to ease inflation. For the rest of the world, aka the U.S.'s trading partners, we want to see stronger growth. That's part of a global soft landing. And this is exactly what the April data showed. Most importantly, though, April's equity market declines, they were held at bay by better than expected corporate earnings growth. Earnings are always the most critical equity market driver, and that they were the backstop for markets reinforces our pro-equities stance. Overly bullish expectations, stretched valuations, and complacency have been concerns we've held for several months. April brought some unwind to those conditions, and we see that as a healthy development for equity markets. We continue to see the backdrop as positive for stocks. At this point, it appears April is nothing more than an overdue breather following a robust 5-month rally for global stocks. And early May is already seeing the narrative flip, as a Goldilocks U.S. labor market report showed cooling wage growth, and that has both stocks and bonds rallying on the return of the soft landing scenario. April also brought validation that our well-diversified approach remains prudent, as our allocations to Canadian, international, and emerging market equities outperformed U.S. stocks. Finally, given that spring has sprung, it is that time of year when the old trope, sell in May and go away, starts making the rounds. We remind clients that staying invested is a much better strategy than following any fanciful urban legend. A simple Google search reveals reams of research debunking this theory across numerous periods and various markets. Now, there is some seasonality to market returns that points to stocks doing better between November and April versus May through October, but that performance varies dramatically year to year. And the overwhelming conclusion of the research is stay invested. So don't follow the folklore of sell in May and go away. Instead, rely on the overwhelming weight of historical evidence that does hold water. Take a well-diversified approach and stay in play. That's the way we saw the month of April. Thanks for listening. We hope to see you next time.